This is the Daily Market Comment by Marios Hadjikyriacos. I'm Maria Pashurdis. Thanks for joining us at XM.com. There's no stopping the mighty US dollar, which continues to slice its way through the currency complex. Stress in equity markets, worries around a synchronized global economic slowdown, and the relentless grind higher in US yields continue to drive up demand for the reserve currency. Once the dust from last week's Fed meeting finally settled, markets concluded that by not acting with sufficient force now, the central bank would need to do even more later to tame inflation. Treasury yields at the longer end of the curve stormed to new highs, which suggest bond traders are increasingly concerned about a Fed policy mistake. The U.S. jobs report did not change much. Non-farm payrolls overcame expectations, but every other metric was a shade softer than projections. Overall, the labor market remains the bright spot in the economy, underscoring the need for the Fed to keep its foot heavy on the brakes. A half percentage point rate increase at the next meeting in June is fully priced in, and money markets imply an 80% chance for a larger 75 basis points hike, even though Chairman Powell effectively ruled that out. The shellacking in equity markets shows no signs of abating, with the combined forces of rising interest rates, slowing global growth, and a furious race to cut leverage wreaking havoc on Wall Street. The tech-loaded Nasdaq lost 1.4% on Friday. Futures point to another round of pain when the market reopens today. China remains committed to its zero-COVID strategy, despite growing signs that the economy is starting to crack. Authorities in Shanghai tightened lockdown rules again over the weekend, fueling worries around slower domestic growth and persistent global inflation as supply chains remain under strain. Currencies of nations that rely on Chinese demand for their commodity products, such as the Australian dollar, have suffered collateral damage. There isn't much on the economic calendar for today, but there will be some fireworks on Wednesday when the latest U.S. inflation print is released. The yearly CPI rate is expected to have declined to 8.1% in April, heralding the long-awaited peak in inflation, not because inflationary pressures have truly abated, but rather due to favorable base effects finally kicking in. Incoming data dispels some concerns around inflation that could halt the frantic rally in U.S. yields, knocking the wind out of the dollar's sails and breathing some life back into battered tech stocks. That's today's Daily Market Comment. Thanks for joining us at XM.com.